So a couple of weeks ago, the Bank of England raised their base rate yet again, this time from 3.5% to 4%. However, it's actually a little bit weird, isn't it, that the average mortgage rate in the UK has actually come down in that time. We're now seeing residential rates starting with a 3 again, and buy-to-let rates starting with a 4. But why is this happening? Well, stick around, because in this video, I'm going to explain exactly what that mechanism is that allows mortgage rates to come down even when the Bank of England are continuing to raise their rates. Before we get into it, if you could please do me the great honour of subscribing to my channel, hitting the notification bell and giving this video a lovely big thumbs up. It really does mean a lot to me, and it's only a little click for you. So as I was saying, the Bank of England have recently raised their base rate yet again, and I have to admit, I was a little bit shocked as to how high they actually raised it. I was actually predicting that they might go up by 0.25%, not 0.5% as they did. This is because going into the new year, we've actually seen some of the green shoots of recovery in the economy, particularly the rate of inflation, which is starting to creep down. Couple this with the fact that when the Monetary Policy Committee met last time, they're the people that actually get together and make decisions on the Bank of England's base rate, a couple of the members actually voted to not increase the base rate at all. Hence why I was thinking there might be a bit of a change in the thought process going on here, and we might start to see the base rate increases come about at a smaller rate or not even at all. In fact, I wouldn't have been surprised if at the beginning of February they didn't actually raise the base rate at all. So why have they actually raised the base rate by 0.5% rather than a smaller amount, or maybe just keeping it the same, particularly, as I said, with inflation starting to creep down? Well, my thoughts are that actually the government and the Bank of England are starting to see that some of the things that they have brought into place are starting to work. And maybe what they're thinking is, if they're working, if we increase what we're doing, it might increase the velocity of getting that inflation rate down, which is obviously going to have a really positive impact on the economy, which I think they want to get the rate of inflation down to probably about 6% by the middle of this year. So it actually kind of makes sense now as to why they're increasing the base rate a little bit more than maybe I thought they would, because they're going to try and pinpoint this number and get there by June, July time. But as I said, point of this video is actually not to do with the economy, not to do with the rate of inflation, not even really to do with the Bank of England base rate. It's to do with mortgage rates. Why are mortgage rates still coming down? Well, it's because we need to understand that mortgage rates and the Bank of England base rate, although there is a little bit of a link, actually one can kind of work without the other. Mortgage rates are less reliant on the Bank of England's base rate and more reliant on what we call swap rates or SONIA rates. Now, what is a SONIA rate? Well, essentially, it's the rate in which banks lend to each other. So in the UK, we have a lot of big banks like JP Morgan, Citibank, RBS, these sorts of institutions that lend a lot of the money that is then filtered down throughout the lending market and lent out by some of the smaller lenders, commercial banks and the like. So the rate in which they lend that money out is obviously a little bit more important than the Bank of England base rate. The two do sort of correlate a little bit, but in reality, it's more to do with how these big lenders want to lend their money out and at what rate. So SONIA rates are worked out at different year increments. So effectively how long that money is being lent out for will mean a change in that particular rate. And at the moment, we're seeing that the longer that money is being lent out for, the cheaper the rate is, which is why we're seeing a lot of lenders really pushing 5-year, 7-year, and sometimes even 10-year fixed rates. The money's cheaper, and it means that lenders can get a much better margin on their money. So if you've got a big lender like JP Morgan lending, say, somebody like Shawbrook Bank, a commercial lender, £1 billion in funding line, they will decide how long they're going to lend it to them for, so say 5 years. So they'll know what the SONIA rate is for 5 years. JP Morgan will then add a margin, maybe it might be 0.5%, might be 1%, and then that is how much that money is costing Shawbrook. Shawbrook can then lend that money out at a margin slightly above that so they can make some profit. And that is really, in reality, how mortgage rates are determined. SONIA rates do have something to do with the Bank of England a little bit, but in reality, they're more to do with the confidence in the market as a whole. And what we have seen, like him or not, that since Rishi has come in and become our Prime Minister, coupled with Jeremy Hunt as our new Chancellor, the economic community, both nationally and internationally, have been reassured that we have the right people in charge to get our economy back to where it needs to be. So whether you're a Labour fan, a Conservative fan, or maybe a monster raving loony party fan, it doesn't really matter that much at this stage. It's just the fact that the people that are in the know are a little bit more comfortable having Rishi and Jeremy in charge of the country than they did with the previous administration. And that's really all we need to know, is that at the moment, the economic recovery is happening. As I said at the beginning of the video, there are some green shoots of recovery that we're seeing. We are definitely seeing inflation rates coming down. We are seeing that SONIA rates, as a result, the interbanking lending rates, are improving. And this is having a knock-on effect to the rates that we're seeing mortgage lenders lend their money out at. So this could possibly continue for a little while, but I do think we're probably getting to the point where we're bottoming out for the time being. And the reality is, only once we start seeing the Bank of England base rate then start coming down will we then see this being sort of fed on to mortgage rates. But I do think maybe we've got maybe a month and a half left of mortgage rates continuing to come down a little bit. So if you are thinking of remortgaging or buying, you're probably there or thereabouts in terms of the market bottoming out. So if you are thinking of doing that, this might be the time to start thinking about it. I know this video was a little bit kind of economicsy, but hopefully you found it interesting. You may also find a number of my other videos interesting. So you don't subscribe to my channel already, please do. I've got hundreds of videos that have already been uploaded covering all sorts of things, not just talking about the economy and mortgage rates, but also property investing strategies and other types of property finance products that you might want to take out to help you on your property investing journey. So check them out. And if you like this video, please do give it a thumbs up and maybe leave me a comment below on what your thoughts are on mortgage rates at the moment. I would love to hear from you, and I do reply to every comment as soon as I possibly can. Thanks very much for watching, and I'll catch you on the next video.